Welcome to the Vaughan Nelson Podcast. Today is the third quarter 2025 Vaughan Nelson Value Opportunity Recap. And with me today is Lead Senior Portfolio Manager, Dennis Alff. With that, Dennis, I will turn things over to you.
Thanks, Dan. Hope everyone out there had a great summer, is ready for the fall. I know all of us down here in Houston are certainly ready for things to get a little cooler. But let's talk about the portfolio. I would describe the most recent period as a solid quarter, with performance hitting a small single relative to the benchmark. While there were several important events over the last 90 days, probably the most significant to the portfolio was the Fed's mid-September decision to cut interest rates. The reason I call this the most significant is due to the impact that single event had on performance. The portfolio was performing exceptionally well from the end of the second quarter through that Fed meeting, both in absolute and certainly in relative performance. However, the Fed meeting proved to be a sell the news event for the portfolio, as many of our housing and other early cycle names rolled over on the interest rate change decision, resulting in some give back during the last 2 weeks of the quarter. Perhaps this dynamic shouldn't be surprising given the market's outsized focus leading up to the event, but nonetheless, it changed what would have been a great quarter into simply a solid one. That said, a win is still a win, and when we look underneath the hood at the drivers of performance, we are pleased with what we see happening. Specifically, the portfolio showed very strong absolute and relative performance in the consumer and technology sectors that were offset by drags inside of our industrial book. On the consumer side, the portfolio benefited from being exposed to some classic undervalued asset opportunities where some simple catalysts appeared during the quarter that unlocked some material gains for us. One example was a holding inside specialty retail, which when we purchased it originally was trading at a trough level reflecting no credit for any kind of growth or for the company's franchise value. During the quarter, the management team rolled out a really smart ad campaign to drive traffic to the store, which forced the market to reevaluate the upside potential of the business, and it drove exceptional upside returns. Additionally, homebuilder stocks that we purchased originally at a discount to their land value had strong returns in the quarter as the decision to cut rates and potentially create lower mortgage rates as a result created some material gains for the portfolio. These positions are also classic undervalued asset opportunities that are identified by the philosophy, where we feel that they are trading at trough levels supported by some underlying business or asset value, and that they're just simply waiting for a catalyst to arrive to unlock sizable gains. Strong performance in our technology names were a function of the other side of the Vaughan Nelson philosophy. Here, the portfolio has some significant exposure to undervalued earnings growth opportunities. The team has felt the fundamentals in the AI and data center build out have been inflecting towards optical and network opportunities for quite some time. Our technology names are positioned in these areas, and they had large gains during the quarter as we saw revenues and orders inflect positively for these companies as the data center revolution continues to grow and expand. Negatively, a few company specifics hurt us in the industrial book. The portfolio had exposure to an electronic trading platform that we really liked as it was able to deploy capital into its growing platform and take share from more traditional manual processes in trading that had been the historical hallmark of the industry. Unfortunately, some other entrants showed the ability to take share away during the quarter, and it resulted in negative returns. As a result, this position was sold. As the market soured, the market soured on an equipment rental company in the portfolio due to its high leverage and some market concerns about a construction slowdown. We continue to hold that position as an undervalued asset where we believe that the company's highly countercyclical cash flows and exposure to forthcoming reshoring opportunities are very much still intact. During the quarter, the team continued to take advantage of price action and evolving opportunities to continue to position the portfolio for chances of outsized success going forward. 14 new positions were added to the portfolio, and these were funded by 13 sells. Admittedly, Dan, this is a high amount of activity for the portfolio, but it reflects the strong price action of several of the sells and the inflecting fundamental improvements we see in many parts of the economy. Interestingly, when we analyze the buys and sells, we're seeing a trend emerge where the sells tend to be larger market cap holdings and the new purchases are below the portfolio's median market cap weighting. In effect, the portfolio is starting to shift down market cap. While we do not target a specific market cap for the portfolio, this dynamic does not really surprise us. Fundamentally, we see an economy that is starting to show broader economic inflection outside of the simple large cap AI opportunity. As things like reshoring, consumer stimulus from the recently passed Big Beautiful Bill, and lower rates begin to have an impact on the economy, we believe these drivers will have a bigger impact on cyclical and smaller companies, much more so than their larger peers. Assuming these fundamental trends continue, we might expect the portfolio to continue to migrate down cap. After a good start for the year, the overall market is in a difficult place. Valuations are certainly full, and many of the broad fundamental drivers we hope to see this year have already materialized and have been priced by the market. The government passed the expected stimulative tax package. The lower rate cycle has officially begun, and enough time has passed for everyone to learn that tariffs are unlikely to crash the economy as currently constructed. These tailwinds are now known and priced into the market. We feel that puts an even greater burden on company earnings going forward to carry the load to allow the market to keep advancing. To that end, we very much like how the portfolio is positioned. We have strong positions in AI, data center, and power generation markets, which we believe is a secular tailwind to the economy. While we are looking out for bubble-like conditions in these areas, given recent price action, we believe that it truly is a secular opportunity and a real driver for growth. Additionally, the portfolio has several positions in early cycle consumer and industrial companies that we believe are trading at undervalued asset-like levels. These names will continue to benefit as rates fall and manufacturing continues to improve domestically. And finally, the portfolio, as usual, is littered with several idiosyncratic situations. These can vary from exposure to the upcoming new commercial airline build cycle, unique consumer innovation opportunities, disruptive fintech companies, and many, many others. When we look at the combined of all these ideas in the portfolio, we feel really, really good about the opportunity to continue to see solid performance through the end of 2025 and through and into 2026. So Dan, let me wrap it up there. I'll turn things back over to you.
Okay, great. Well, thank you very much for that, Dennis. And we'll start taking a look at returns in the third quarter of 2025. Vaughan Nelson Value Opportunity Strategy returned 6.68% gross, 6.46% net. The Russell Midcap Value returned 6.18%, which brings the year-to-date return for the Vaughan Nelson Value Opportunity Strategy to 10.91% gross, 10.21% net, and that's against the Russell Midcap Value at 9.55%. Over the last 1 year, 13.89% gross, 12.93% net, and 7.58% for the Russell Midcap Value. Over the past 3 years, Vaughan Nelson Value Opportunity Strategy has returned 19.83% gross, 18.83% net, and the Russell Midcap Value is at 15.51%. Across the past 5 years, 16.29% gross, 15.31% net, and 13.66% for the Russell Midcap Value Index. And finally, over the past 10 years, the Vaughan Nelson Value Opportunity Strategy has returned 10.33% gross, 9.4% net, versus the Russell Midcap Value Index at 9.96%. And with that, Dennis, that's a wrap on the third quarter. So thanks for joining us, and we'll have you back here soon.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.